So a lot of you have probably never heard of the secret of cointegration, which was pretty much the remit of institutional traders until people like PairTrade Finder and others began bringing it out into the retail trading market. What the heck is cointegration and why does it matter to me? Well, to put it simply, if it's used correctly, cointegration can help make you rich. Let me explain. Back in February 2015, two econometricians, Nicholas Huck and Komivi Afawubo, published a rather extraordinary piece of research in applied economics that should interest any equity trader. Their phenomenal research is titled Pairs Trading and Selection Methods. Is cointegration superior? But first, a quick primer on a consistently profitable hedge fund secret. What is cointegration? Investor Dictionary defines it as cointegration is an economic technique for testing the correlation between two non-stationary time series. Are you asleep yet? I think I faded out a bit on that one too. Let's cut to the chase and I'll explain it to you simply in the context of how it applies to your trading success. Let's take the example of a drunkard's walk. Suppose you see two drunks representing two random walks wandering around. The drunks don't know each other. They're independent, so there's no meaningful relationship between their paths. This guy can go this way, this girl or guy can go that way, or they can go the same way. They're independent. But suppose instead, let's take a different example. You have a drunk walking with her dog. This time there is a connection. And what's the nature of that connection? Well, notice that if you look at these paths, that although each path individually is still an unpredictable random walk, given the location of one of the drunk or the dog, we have a pretty good idea of where the other is. That is, the distance between the two is fairly predictable. What do we mean by that? For example, if the dog wanders too far away from his owner, he'll tend to move in her direction to avoid losing her, as she needs to let him into the house. If she wanders too far from the dog, then she will go back to him or call him to come, as she doesn't want to be woken up later with barking at the door. So the two stay close together, despite a tendency to wander around on their own. We describe this relationship by saying the drunk and her dog form a cointegrating pair. Now for stocks, and how to apply this, as we said in the beginning, to try and make you rich. So if stock A and stock B over time are cointegrated, it means that the price ratio between the two, A over B, is likely to revert to its mean if it diverges substantially from that mean. Let's take an example here. Juniper Networks and Lumentum Holdings. They're cointegrated and they're correlated. A chart of their relative performance over the last year shows that whenever the performance diverges, it tends to reconverge. So they started the year here at 0, and this is a chart of the daily performance of each of these. The green is Juniper and the blue is Lumentum Holdings. So Juniper started the year stronger, and its relative performance versus Lumentum diverged. There's a bunch of space between these two lines, and when that gets to a high enough level, that's something we can look to trade. But what you'll see is that even though they had very different beginnings of the year, they did reconverge in relative performance. Again, further along in the year, they diverged substantially, and then they reconverged. And right after they reconverged, they again diverged, and that fully reconverged later on. So it's divergence, reconvergence, divergence, reconvergence, divergence, reconvergence. That is the nature of the cointegration you can see here. And as two highly liquid U.S. equities, the JNPR and light relationship is tradable. This relative performance, divergence, reconvergence, or cointegrated relationship can be seen in the reversion of the price ratio to its mean. This is the 100-day moving average over the last year, and every time it diverges, red arrows, it then quickly reconverges. And these E's are entries on trades, X's are exits on trades, and you can see every one of these trades on this pair was profitable over the last year. Although this one went offside and got into pretty negative numbers, it did eventually come good. So every time it diverged, it reconverged, diverged then, reconverged, diverged, eventually reconverged, diverged, reconverged quickly, diverged, reconverged quickly, diverged, reconverged pretty quickly. Okay, So that's how the cointegration relationship becomes tradable. Cointegration. People talk a lot about correlation and cointegration in pairs trading. Look, cointegration surpasses correlation as a pair trade selection method in pair trading. To make a profit, we need the ratio of the prices of stock A and stock B to revert to its mean. As I showed you on the previous page, correlation measures the tendency of two stocks to move together. However, two positively correlated stocks may continue to diverge despite the correlation. So stock B is going up, stock A is also going up. So they're correlated, their relative price, they're correlated. They have a positive correlation between them. But trading a reversion between the price of A to the price of B will lead to ever-widening losses. Okay? There's no reason at all why they need to reconverge. They're just moving in the same direction. That's what correlation means. Cointegration, on the other hand, means they will reconverge or have in the past. Now back to that very important research paper we were talking about. Allow us to paraphrase the holy grail findings of this technical paper. Their chart is worth 1,000 words. So, here you have the chart, and it's from August 2000 to September 2011. This chart shows the results of testing 3 different pair trading selection methods using the S&P 500 stock universe, from August 2000 until September 2011. They use 3 methods: the distance method, which just uses correlation, the stationarity method, and the cointegration method. Now this chart, so that you understand, you've got the dates on the bottom, and then you've got what's happened with your initial trading capital, starting at 100% all the way up to, what would that be? 1,000% or 10x, and then 0.5, which would be 50% or a 50% loss. This is showing the cumulative excess returns on a log scale, including transaction costs. Pair trading strategies with a 2 standard deviation opening trigger, and they've compared to the equity premium. This black line is the equity premium. So you started here in August 2000, you lost a lot of money, and then you recovered. And then you lost again in the 2008 crash, and then you recovered. Not a great time. The stationarity method and the distance methods, they made money. They made reasonable money. But what's extraordinary is to look at the cointegration methods. In cointegration 1 year, you've got almost 10 times your money. Let's see that again. They used a 2 standard deviation entry stretch and a 0 standard deviation exit stretch. They use 1-year lookbacks and 2-year lookbacks. And as we can see, distance and stationarity beat the equity market premium, but not by a huge margin. Though they did much better, and they didn't have the drawdowns in these market crashes. However, the excess return generated by a cointegration-based pair selection strategy is radically positive. This is the 2-year lookback. This is the 1-year lookback, and look at where they are 10 years later, almost 10 times their money. And on this one, almost 6 or 7 times. With a 1-year lookback, 2 standard deviation entry stretch and 0 standard deviation exit stretch, cointegration-based stock pair trading delivered an average 1.75% excess returns per month, unlevered over 134 months with a 67% win rate. Using a 3 standard deviation entry stretch and a 0 standard deviation exit stretch. Results are even more impressive, delivering an average 5.66% excess return over the market per month, unlevered over the same period. That's 134 months, with 76% winning trades. That last scenario generates a capital value 10x greater after 11 years than just receiving the equity premium with little or no drawdown in the 2008 market meltdown. To quote the authors, including transaction costs, robust strategies are the following: cointegration. Whatever the length of formation, lookback, period, or the opening trigger, 2 standard deviations or 3 standard deviations. Returns are especially high with monthly excess returns, including transaction costs, greater than 1.38% and going up to about 5% over a period of more than 10 years. These are clearly the main and most impressive empirical findings of this article. That's why we wanted to highlight this article to you, and that's why we think every equity trader should know this study. Bottom line, if you have a powerful trading software that can perform the millions of calculations necessary to find highly cointegrated stocks and generate simple entry and exit signals of when to trade them, which can be auto-traded into IB Trader Workstation with just 1 click, you can capture the potential profits these co-integrated pairs represent. PairTrade Finder's Ultimate Alpha 3 does this job magnificently, we believe. Our latest platform launched at the end of 2023 after 2 years of development. Ultimate Alpha is your gateway to finding, monitoring, and auto-trading the best stock pairs. Pair trading can protect you in the event of a market drawdown and can make profits in all market conditions. What's more, we've done the heavy lifting and preloaded it with our highly co-integrated top US equities pairs that will immediately begin calling high-probability pair trading signals. Don't wait. Subscribe now.